Hello everyone, and welcome back to the second part of this B2 English listening practice video. In this section, we will continue discussing the reality of stock market investing, particularly focusing on the risks and strategies involved when market conditions change. While recent market conditions have been favourable, many investors are still waiting to recover their previous losses. Those who have made money are often the ones who invested during the market's lowest points and avoided impulsively buying individual stocks. They patiently built positions in index funds, which are generally safer over time. As the market continues to evolve, there may indeed be another wave of growth across various sectors and indices. However, the key to profiting remains the same: low entry costs and careful planning. Chasing stocks at high prices carries significant risks, and individual stock investments are far riskier than index funds. After a bull market ends, it is usually the case that more people lose money than make it. The problem with China's stock market isn't that it never offers opportunities to profit. Instead, it's that these opportunities are extremely hard to grasp. When the market starts to rise, it's often difficult to predict how far it will go. The rise is quick, and before most people realize it, the bull market is already halfway over. By the time investors decide to go all in, the market has usually peaked, and the decline begins. Therefore, most investors either make a small profit or just manage to break even. This is the norm. While the current market looks promising, it's essential not to get carried away. Avoid borrowing money to trade or leveraging your investments. Use only discretionary funds and focus on long-term strategies like holding on to index funds. From past experience, we know that market surges don't last forever. While some sectors may rise to new highs, others will lag behind or face corrections. Individual stocks, in particular, carry a greater risk of failure. After every bull market, the majority of investors lose money. Only a few experienced investors are able to sell at the right time, while most are left with losses. As we participate in the market, it's crucial to remember that financial risk is always present. Even though the current situation appears favourable, we must be cautious not to overextend ourselves. In the end, it's better to treat stock market investments as a small part of our overall financial plan. For most people, it's far wiser to maintain their regular jobs and not rely entirely on stock trading for income. When looking at the market from a long-term perspective, those who don't trade stocks are often better off than the vast majority of retail investors. For most investors, the stock market may seem like a quick way to wealth, but it often leads to nothing more than paper gains that disappear just as quickly. So, the lesson here is simple: invest rationally, pay attention to risks, and never invest more than you can afford to lose. When market conditions seem too good to be true, it's essential to remember that the faster something rises, the faster it can fall. Don't forget to manage your portfolio wisely, secure your profits slowly, and never get too greedy. Now, I'm going to ask you 2 questions about today's article. Write your answers in a comment down below. 1. Why is it important to avoid leveraging your investments during favourable market conditions? 2. What makes long-term strategies like index funds safer than individual stock investments? Okay, that's all for today's lesson. Keep practicing your English, and I'll see you next time.